All right, today we are digging into the latest earnings report from Gladstone Investment. You probably know them as Jane. And, this wasn't just any old quarter. It tells this really fascinating story about strategy, about confidence, and what it actually means to make real money.
So let's just dive right in with a really basic question. When a company says it's profitable, does all that profit look the same? I mean, is a dollar earned in cold, hard cash the same as a dollar that's just promised on paper? This very question, it is at the absolute heart of Gladstone Investment's entire strategy.
And it all starts with this thing called PIK income, that's paid in kind. All you need to know is that it's basically a non-cash payment. So instead of getting interest paid in actual dollars, a lender gets more debt or maybe some stock. Yeah, it looks great on an earnings report, but it's not cash you can actually go out and spend.
And bam! This quote from Gain CFO really gets right to the point. This isn't just some boring financial detail, you guys. This is a declaration of who they are. They are deliberately, and you can tell, proudly avoiding this kind of paper income. It's what makes them different.
And that brings us right to their core philosophy, a strategy that's built 100% around generating real, spendable cash. The goal? It's simple. Use that cash to fund real, tangible dividend payments for their shareholders, month in and month out.
So the big question is, how did this real money strategy actually play out this quarter? Well, after being a little more conservative for a while, it looks like Gain decided it was time to put its capital to work. And let me tell you, they did it in a big way.
A very big way. In just the first quarter of their new fiscal year, they pumped a massive $130 million into 3 brand new companies. This is a huge signal of a major strategic shift, an acceleration.
And this just lays it out perfectly. To put it in perspective, in just one quarter, they've already deployed more than half of the total amount they invested across the entire last fiscal year. They are not messing around. They are clearly stepping on the gas here.
Now, you might be thinking, how can they make such an aggressive move? Well, it's only possible because they're operating from this position of incredible strength. They've got over $150 million available in credit, they raise even more cash from their stock program, and their asset coverage ratio is way up at 189%. I mean, that's well above the 150% that regulators require. They have the firepower.
Okay, let's move on to the actual results. Because while the strategy is crystal clear, the numbers this quarter, while they tell a bit of a more complex, kind of mixed story that the market really had to chew on.
So here's the deal. You had this split result. On one hand, they beat analyst expectations on earnings per share. That means they were actually more profitable than everyone predicted. But, on the other hand, they slightly missed on total revenue. So they brought in a little less cash on the top line than folks were hoping for.
Now, when you first look at this chart, you might think, uh-oh, their net asset value per share went down. That's not great. But the story here actually reinforces their whole strategy. The main reason for this drop was a huge 54-cent supplemental distribution they paid out to shareholders. That's real cash from a successful investment they cashed out on, going right back into investors' pockets.
And this brings us to the real test for any company, right? It's one thing to have a great strategy on paper, but can that cash-first approach really hold up when things get rocky in the broader economy?
And the pressures are definitely real. You gotta give management credit, they were very open about the challenges. They're dealing with fierce competition for new deals, they're feeling the squeeze from tariffs on their existing businesses, and just like all of us, they're keeping a close eye on a potentially slowing economy.
This all created this really fascinating disconnect. Internally, you have management like their president, David Dullum, being super optimistic. They're pointing to all the great deals they're seeing and how strong their finances are. But the market? The market reacted with a lot more caution. The stock actually dipped a little. It just goes to show you that investors are trying to balance Gain's internal strength against those big external economic risks.
So, when you put all of these pieces together, the strategy, the numbers, the challenges, the market reaction, what's the big picture? What's the real story of this quarter?
The number one takeaway is that Gladstone Investment is confidently shifting gears. They are using their rock-solid, cash-focused financial position not to hide from an uncertain market, but to actually lean into it and aggressively chase growth.
And that leaves us with some really critical questions going forward. Watching how these things play out is going to tell us if this bold new strategy is really going to pay off, especially if the economy gets even tougher.
Which, brings us right back to where we started. And a final thought. Gladstone is betting its entire strategy on this one idea, that in a shaky economy, real, tangible, kind of boring cash is king. This quarter was the first big test of that bet, and it proved they have the guts to put that cash to work. The question now is whether boring will end up being brilliant.